Master your money, free your future. Welcome to Budget for Life. My name's Jeremy. I'm a financial advisor, not a professional YouTuber, and this video is not financial advice. I'm here to talk about, from a level-headed perspective, companies and particularly GameStop. And in this video, I want to talk about why GameStop is the largest SPAC that you've never heard of and begin the conversation on how would you value GameStop's SPAC, GameStop's asset management business. Now, I just want to say thank you to everyone who's joined the channel as fans and friends. Thank you to the subscribers. We're on a march to 2K, so thank you. There's only 112 spots left. So get in while the getting's good if you want to be part of the Y2K sub club. So yesterday I made this video about why GameStop's cash is worth more than you think and broke down reasons why you would value GameStop's cash at a multiple that's higher than 1 to 1. It's worth more than just literally the cash value. And there's a lot of reasons for that. I got this great comment from uh, from Ryan. He said, "If a super rich dude put 10 billion into the bank and went public with just the cash and no actual business, what kind of multiple would the street give it?" And I want to talk about this question because that is the nature of the conversation I'm having right now. Because the answer is more than 1 to 1. It would be higher than 1 to 1. And what Ryan is asking is basically what type of valuation would a SPAC receive, right? A SPAC is a specialty purpose acquisition company. A SPAC is a company that has no business operations. It has nothing, it has not even necessarily any publicly communicated acquisition targets. It's just a publicly traded shell company with money in it and someone as the lead or the owner, the CEO, the CIO of the SPAC. And so the question becomes, historically, what type of multiple do these SPACs trade at, right? What type of multiple of net asset value of cash, net of debt, would you place on a a company that exists to acquire, to invest, but has not yet communicated what it's going to acquire or what it's going to invest? Because that is effectively what GameStop's asset management business is right now. They have a vision to become a holding company, to own multiple organizations within their asset management business. But right now, their asset management business holds a almost completely cash and some Bitcoin portfolio. And they've communicated, though, it's not excess cash. It's not sitting there doing nothing. It's opportunistic cash waiting for the opportunity to purchase companies. So, how do you value that? There's several things we could talk about here, and I'm just going to hit a few different points, and it's going to culminate at the end because we're talking about how could it be valued and then how should it be valued, and this isn't the final conversation, but I want to respond to Ryan here with a couple points that I want you to see, and I'm going to reference some conversation with ChatGPT just so y'all can know I'm not just pulling this out of my butt. Sometimes when I make notes on a spreadsheet, y'all might think that I'm okay. Says who, right? Says who? If a rich dude put 10 billion in the bank, what would that really do, right? Well, it would do something, right? And the reality is, 10 billion in a SPAC would be the largest SPAC ever, ever, ever. The largest SPAC to date has been a $4 billion SPAC, $4 billion of assets, $4 billion of cash ready to use for investment and acquisition opportunities. So a $10 billion SPAC would literally be 2.5 times the largest SPAC that's ever happened. So as we talk about what do SPACs normally do, we also have to place some type of premium on, well, a larger SPAC would command even more of an interest than an average SPAC, right? And as far as super rich dude goes, again, if you're talking about an anonymous person, it's hard to really have that conversation from a super granular level. But if we're talking about Ryan Cohen, who's not just a super rich dude, but is a person who has a really proven track record of really impressive returns on every single investment decision that we know of that he's made, well, yeah, that would also command a higher premium, a higher multiple than what an average SPAC would receive, right? And for all these reasons, GameStop's asset management should receive a higher multiple than an average SPAC. But let's talk about an average SPAC because I'd love to have the conversation of GameStop's asset management business being valued similarly to a SPAC because at the very least, if you open that can of worms, you're already coming to the light of GameStop's cash is worth more than just the cash. GameStop's cash is worth more than literally cash in your bank. Cash that you invest for yourself is not worth from a level-headed perspective, not worth the same as cash that Ryan Cohen invests. You as an investor are not as valuable as are not as marketable, are not as proven as Ryan Cohen as an investor. Right? That's not a hot take. That's not um, hopium. Okay, this is just there's some type of premium that you put on the Ryan Cohen genius, just like you would for other SPACs. But let's talk about what could a SPAC be worth? What should a SPAC be worth? You had Bill Ackman's SPAC, Pershing Square. They traded 2 to 3 times net asset value at the peak. And from a base level, they were trading 1.3 to 1.6 times for a while until some momentum started building on some rumors of the Universal Media Company. Like once people started finding out what Bill Ackman was interested in acquiring, it heated up to a 2 or 3x their cash value, their net asset value. But even before those rumors, it was already at, say, on average, a 1.5 net asset value for Bill Ackman's SPAC. And Chamath, historically, 1.3 to 2x net asset value for his SPAC valuations. And then you had DJT that went up to 10 times net asset value in that SPAC. And so what are like multiples that you could expect with a SPAC valuation? And how could that compare to, say, Ryan Cohen? Well, let's talk about it a little bit more because if you're just talking about someone with a really proven investor track record, which Ryan Cohen's track record as an investor is more impressive than Bill Ackman's. Bill Ackman's has had several huge failures, even predating this SPAC, which was also a failure on his part. But when you net out his compounded returns, it's like a 16% annualized return. And we don't know literally Ryan Cohen's personal return, but in this video that I made yesterday, how GameStop's cash is worth more than you think, we broke down the annualized return rates on every notable investment he's made, and they are all like the lowest one is Apple, which is a 25% compounder over an 8 year period of time. The others were GameStop's over 50%, Alibaba over 80%, Chewy over 300% compounded annualized returns. So Ackman to Cohen, advantage Cohen. Okay. Then you talk about the retail hype. Okay. GameStop's genuine, um, huge appeal, like a larger percentage of direct registered shares by retail investors is what GameStop has, larger than any company ever. So a cult-like following, social media memes. Have you ever heard of memes as it relates to GameStop? Right? And then you talk about the speculation of what could happen, right? So when you add in the track record and then you put in the retail backing, you're talking about a company, a SPAC, an investment vehicle that has no operations yet. No operations yet, just a shell company that's only holding cash. You're talking about 2 to 5 times net asset value. And then you're talking about word gets around of what they are going to buy, which we don't have that yet with GameStop. But how high could it become? You could talk about a 7 or a 10x net asset value. And how would the market rationalize it? Basically, everything that's above cash is like an option. It's it's the premium you're paying for Cohen to be the investor. So obviously you wouldn't pay me 20 bucks for me to give you 10 bucks. If that was the end of the deal, that wouldn't be worth it for anyone. Sorry, I've got a scratch in my throat, guys, but we're pushing through it because I want y'all to know this stuff. But would you consider paying me 20 bucks, basically an additional $10 for $10 worth of my company? Well, if that was the only way you could invest in my company, you would consider it if you believed that I have a superior ability as a company leader or as an investor. So 10 bucks of the 20 you paid is represented by company cash. The next 10 bucks is representative of your opinion that I will be able to outperform what you would have been able to do. Basically, you're saying if I give this company $20, I think they will make, basically, you're saying, I think the company can do more with $10 than I can do with $20. That's basically what you're saying. Because I'm burning $10 in premium. I'm burning $10 on option value, right? There's $10 of actual cash this company holds that I can get back for cash, right? But then there's $10 that I'm just throwing into the vortex. I'm just betting on outperformance. So I could have kept my $20 and invested it, or I could give them 20 but net out the 10. I'm really giving this company $10 of premium. And is it possible that someone would give a company a 2x net asset value? Yes, very possible. Um, Now, what should happen, right? A typical SPAC, if there's no hype whatsoever, if there's no like high level of asset concentration, there's no particularly visionary CEO, there's no retail following, it would still be a 1.1. All right, if it's an absolute no-name tiny spike, maybe it's literally just a 1.0. But if you have some type of, um, you know, capital raise or some type of CEO track record, then okay, maybe a 1.2. So if you want to have like the base level of if GameStop wasn't a company, like if you didn't have the GameStop name and you didn't have the Ryan Cohen name and you were just a random SPAC, you'd say maybe 1.1, 1.2 would be the multiple that that would command on cash. You add in the retail hype and you add in the superior to Bill Ackman level investment history, and now you are talking about easily justifying a 1.5 to maybe even 3 plus X net asset value, right? If you have a Buffett tier allocator with a Musk tier fandom, a 5X multiple is absolutely plausible. Okay? It is not a valuation that is tied to the cash itself. It is a valuation that is the premium that you place on the allocator. Like if Elon Musk started a SPAC this week, it would trade at a much higher multiple than 1 to 1 because there is an assumption based on his track record as a value creator combined with his retail cult following. There is an assumption that Musk could do more with $10 than you could do with $20. Maybe more than what you could do with $30. Maybe more than what you could do with $40, right? What is the ceiling and what type of premium are you placing on the allocator, right? So, a couple other points I want to make here. 10 billion again, the largest SPAC ever. Okay, four like would be the largest SPAC ever. And check this out. ChatGPT says only someone like Elon Musk, Warren Buffett, or Jeff Bezos could credibly attract that scale, right? Like, or hey, how about Ryan Cohen, ChatGPT? Basically, they're saying ChatGPT is basically like impossible. This would be 2.5 times the largest SPAC we've ever seen, which, by the way, traded at upwards of 3x net asset value. If you had a SPAC that was 2.5 times that, with a CEO that had a better track record than that, and a retail following that is much more like passionately and cult like invested in a CEO than that. Like Ryan Cohen's retail memeness is much greater than Bill Ackman's. All of these things would command a premium to whatever Bill Ackman's SPAC commanded, which at the low end was 1.3x. At the very low end was 1.3x, was really more like a 1.5x on average. And then as speculation began to grow, as clarity began to grow for what they might buy, it blew up to about 3x. In GameStop's case, before I move on from this point, basically you'd be saying, how much better is Ryan Cohen as an investor than Bill Ackman? Is he 10% better? Is he 20% better? Right? How much a premium do you place on the larger size of the SPAC? You know, the SPAC being 2.5 times larger, what type of premium does that give the valuation, the potential for outperformance? Is it a 10% bump? Is it a 20% bump? And then the retail following, what is the impact on the valuation for the SPAC to know that the leader of the SPAC has a incredibly attached investor base, a more enthused investor base than basically any CEO in history? What type of premium do you put on that? Is that a 10% premium? Is that a 20% premium? And if you said Bill Ackman's SPAC was trading at a 1.5x on average net asset value, and then you multiply, let's say those three, let's just say you say that's a 10% premium for those three different things we talk about: Ryan Cohen's investment history, Ryan Cohen's retail following, and the size of the SPAC that we're talking about. Okay, 10%, 10%, 10%. Now you're talking about a floor case of a 2x net asset value, right? Pretty crazy, unprecedented. And let me keep going here because, again, thinking through this thoroughly is actually super important. And there's this: what should it trade at? What could it trade at? What should a SPAC with $10 billion raised, no deal, but Cohen's name and Cohen's investor base backing it, what should it support? It kind of depends on what type of investors are buying into it. If you're buying into basically Ryan Cohen is Warren Buffett, like if it's a Warren Buffett type of investor that's investing in this SPAC, that's very, very grounded, only looking at rate of return and risk versus reward, you're looking at a 1.5 to 1.8x net asset multiple, according to ChatGPT. Or if you were to take those 10% premiums that I just described with Bill Ackman, but you started from a 1.3 base, which was the lowest that his SPAC was ever valued at. If you take that 1.3 times three different 10% premiums, you're looking at a 1.73 net asset value multiple. So again, on the conservative end, 1.7 is like really the lowest that you would think fairly a $10 billion SPAC led by Ryan Cohen should command. If it gets into hype, right, the next GameShire stop away, right? If we start getting clarity on what GameStop's going to do with the money, or if we have a market crash, And we know that, therefore, GameStop has an opportunity to invest this money into discounted investments. You could see that net asset multiple go to 2.5 to 3x, 3.5x pretty easily. Not from a mania perspective, but just from a momentum perspective. Like if the market is down 50%, GameStop rationally should command a higher premium on the cash than it does when the market's at all-time highs and GameStop's sitting in cash on the sidelines, right? So conservatively, 1.7 net asset value, a little bit of momentum, you're talking about a 3x net asset value. And if you're talking about a cult mania, like it becomes a global phenomenon that this company is about to change the world, right? This is going to flip legacy financial institutions on their head. This is the next revolution in finance. Then there's really no telling what type of multiple it could command, even before any type of clarity exists on what they are going to do with the money necessarily. Now, is GameStop a SPAC? No, it is an investment company. But here's the thing with a SPAC. A SPAC has to invest its money within 18 to 24 months. So GameStop has no timetable to invest their money. They don't have to invest it within a specific amount of time. A SPAC, if they don't acquire a company within their fixed time frame, they dissolve. GameStop, they can sit on this cash for as long as they want to, and there's no intrinsic threat to their SPAC. There's no intrinsic threat to their organization. And in fact, the cash pile is only going to grow, whereas a SPAC's cash pile might deteriorate over time as you're paying, right, the different investors and managers of this SPAC. You might lose traction, but GameStop SPAC is nestled under the umbrella of GameStop's company, which is supported by a booming retail business. And so their cash is actually growing quarter after quarter. There's no rush for them to invest. There's no risk intrinsically to the investor if they don't invest within a specific amount of time. And so you would expect, again, some type of premium related to GameStop's SPAC above what you would expect from a typical SPAC in light of the fact that they don't have a specific time frame that they have to allocate the money. Let's see if there's any other particular points that I wanted to make as it relates to that, because I think we're getting pretty close to the end. Oh, I just wanted to talk about GameStop. If they're not a SPAC and they're just viewed as other holding companies, right? Like Berkshire Hathaway, Markel, Lowe's, Icon, all of these companies trade at some type of premium to their book value, some type of premium to their net asset value. Again, you have a 2.7 for Icon, 1.13, 1.37, 1.59. So you could deep dive all of these companies individually and look at why are they receiving the type of price to book that they receive. But we know this, that every asset management business receives some type of multiple on their book value. Now, should the multiple that GameStop receives on its book value be incredibly high while they are still only a SPAC, only a cash position? No, it shouldn't be super high. It shouldn't be a 30x book value. It doesn't mean it couldn't be that, right? You could have retail mania frenzy come in just like GameStop had in January of 2021. Like you can squeeze a stock and it can be worth who knows what. But to justify that gets kind of crazy if you're talking about, a 30x, right? GameStop can do more with $1 than what I can do with $30, right? A 30 to 1 premium That's a really stinking expensive option on Ryan Cohen and GameStop as an asset management business. But a 2 to 1 is not particularly bullish, or it's not particularly like obscene to envision. What do you guys think? I'm going to start diving into it in future videos as far as really granular. How do you value GameStop's asset management business? But suffice it to say that I think a 1.5 multiple for their cash position is really, really, really the worst case that you can justify, considering the fact that the market tells you for all these other SPACs that, hey, a 1.3 to a 1.6 is very uh, expected when you're talking about a $1 billion plus SPAC funding with a CEO who has some type of retail following or some type of public fame, like a Bill Ackman or a Chamath, and then you add in the layers of, in GameStop's case, it's 2.5 times the size of even the largest one we've ever seen, and the investment track record is even more impressive than what we've seen from a Chamath or an Ackman. And the retail following, the meme following, again, is larger than we've seen with any company ever. Does that mean that the stock is going to spike tomorrow? I'm not talking about the stock price right now. I'm talking about fundamentally what type of valuation should GameStop as an asset management business command? And rationally, you would think that worst case, a 1.5 net asset value is really the lowest justified valuation for their asset management business. And that alone represents a 30% upside for the total valuation of the company, not even factoring in their retail business, which worst case is conservatively worth 8.7 billion. So as a company, you are looking at a $22 billion plus or a $50 per share plus valuation of what it fundamentally supports from a very level-headed, very conservative perspective. I will save a future video to talk more about the convertibles dilution hypothetical scenario, mapping that out, helping you guys see the way that I can value that cash and the way that you can value that cash, as well as some more medium fair case and fly case or bull case scenarios of what type of valuation could GameStop's asset management command. But I wanted you guys to see some of this conversation with ChatGPT because this question is a great question, and it's worth it for you to ask yourself this question, to do your own due diligence and come to a conclusion that that hypothetical scenario, which is not hypothetical, it is actually real. It is actually really here, right? It is actually really happening. That hypothetical is worth something beyond just the pure cash value. It is worth some type of multiple of their cash value. Maybe you think it's only a 1.5x multiple that it justifies. Maybe you think even 1.5 is crazy and you think it's a 1.3. I would counter with, why do you think that GameStop's multiple should be less than these other examples that we just saw when we know that GameStop fundamentally is set up in a strategic advantage compared to those other companies? I would say, why do you think it's worth less? But then I would also counter with, why do you think that they will not be able to raise any more billions of dollars? So even if you thought 1.5 is rich and 1.3 is a more fair floor case scenario, well, okay, 1.3x their cash today, but then how much cash are they going to continue to raise? And if you're going to model that GameStop has no ability to raise any more cash whatsoever, I think that's a little bit short-sighted, right? I don't think historically that you're being honest. If a company has been able to raise $8 billion over 15 months, even if you only value that at a 1.3x net cash, it's like, okay, well, plus, how do you value the cash that they're going to raise? Because they're not done. Not only is this the largest SPAC by 2.5 times that the world has ever seen, but it is getting larger. It's getting larger quarter after quarter, supported by creative ways that Ryan Cohen is raising money and also supported by fundamentally the retail business just dumping more cash quarter over quarter into their SPAC business, into their asset management business. So how would you value the cash? What's the worst case that you think's fair for their cash? Did you learn anything in this video? If you did, would love a sub, would love a comment, would love a like, a share, a thumbs up, a purple heart, whatever you want to do to engage. I appreciate it so much. That's all I got for y'all today. I will see you in the next one.